John, as we sit here mid-year, markets have been pretty chaotic. How are you feeling about the muni market and how has it done?
I would characterize the muni market as very resilient amid a lot of interest rate volatility. Even if you go back approximately 1 year ago, the tariff tantrum set off a lot of rate volatility, a lot of concerns about inflation. Just as inflation started to retreat back to target, the conflict in the Middle East broke out, oil prices spiked, and the renewed fears, changing the view of potential future Fed rate cut policy, throwing that up into the air. In the meantime, though, I would emphasize that munis have actually outperformed moderately. They've outperformed US Treasury securities slightly. They've outperformed things like corporate bonds somewhat. And they've outperformed even while absorbing a third consecutive year of record supply. I think how they've done that, uh, there's been great interest in the asset class. Great interest in the asset class because credit conditions have been quite stable. In fact, revenues are still growing. Upgrades still exceed downgrades. That's the sixth consecutive year where that's the case. Uh, Tax benefits just continue to be more important, particularly on the state level, but also on the federal level. And as a result, fund flows have been the second highest on record for the first 5.5 months of any given year since 1992. So I think there, as you point out, the macro environment, the geopolitical environment has contributed to a lot of interest rate volatility, but now we're at the high end of really a 20-year range in interest rates. And that's actually the good news is that's actually been stimulating a lot of demand for the asset class.
That's great. Now, I know, John, there's been a lot of noise in the marketplace about the Fed, about the new Fed chairman, rates, and then fear of inflation. What are your thoughts about the economy broadly?
Sure. Well, from a economic perspective, the data has continued to exceed expectations. So first quarter GDP was 2%. That's reasonably solid for real GDP growth. Second quarter, for most projections, should be an acceleration, actually, from the 2% level. The Atlanta Fed Now GDP forecaster has growth at potentially 4%. Meanwhile, the unemployment rate has stayed low. There were some concerns about softness in the job market last year, but it stayed at 4.3%, with the most recent month being 115,000 jobs added and unemployment claims staying very low. So overall, the economy feels pretty healthy. The big shift, as you alluded, has been change in Fed rate expectations. Going into the war in the Middle East, the market was anticipating 3 cuts for the year 2026. That's shifted. Those 3 cuts are kind of out of the futures market. And now there is some probability of a hike built into expectations. I think that could be proved to be a bit premature because it's mostly driven by oil prices and the risk that higher oil prices will filter through the economy, although we are somewhat less oil dependent and we're obviously a much better producer of oil, and the strait is most likely going to experience, some kind of a reopening in the relatively near future, I believe, and that should create some leeway for the new chairman to go slow in any particular direction. If you look at CPI, PPI, and core PCE deflator statistics, they have picked up, but they could actually come back down before it becomes necessary for the Fed to say overreact to short-term volatility.
Yeah, I can see that too. Is it just an inflection point or is it a longer problem? So I guess we'll see how soon we get out of the skirmish, we'll call it. But now, as we turn to current environment, second half of the year, I know you're very constructive on entry point and where you want to be in the muni cycle. How are you feeling about right now as you look at the portfolios and you look at yields and all those things?
Well, we're always looking at the overall level of interest rates, the ratios of municipal bonds versus treasury bonds, things like taxable equivalent yields based on current tax policy for the individual investor, particularly in that top tax bracket, and then trajectory of credit fundamentals. So taking them one at a time, rates are fluctuating depending on the specific date and the specific part of the yield curve. We are approximating some of the highest overall yield levels in 20 years. And then that's for US Treasury bonds and for municipal bonds, because the ratios of high quality municipal bonds relative to treasuries are fair to cheap, particularly when you get beyond 10 years in maturity. You get out to the long end, and munis yield about 90% of treasuries for that AAA slice. But of course, most of the market is AA, single A, really yields getting close to around 5% for longer term high quality bonds. And that does tend to be an important sort of psychological line where people put more money to work in munis when they can get a 5% for perhaps for psychological reasons. That is exciting on a taxable equivalent basis as well. For many individuals, that can equate to very high single digits, 9%, maybe 10% if you're talking about a specific state tax benefit on top of your federal tax benefit. So I think entry point of yields does have a very strong correlation to your longer term total returns. And particularly if you look at a 3-year holding period, 4-year, 5-year holding period, something a little bit longer term, the yield is going to have a big influence, a very strong correlation to those longer term returns. So I think returns, and particularly in a taxable equivalent sense, look attractive. Credit trajectory, if we look at, take the poster child of California, revenues continue to materially exceed expectations, making it easier for large states like that to balance their budgets. And as I mentioned, 6th year in a row of upgrades exceeding downgrades, and very low defaults, mostly because the revenue environment is so robust and expenditures are growing just in the very, very low single digits. So credit trajectory looks stable to moderately improving, rates at multi-decade highs, tax benefits very good, and people could do even a small amount of rebalancing to shore up that fixed income allocation in the overall portfolio. This does look like an opportune time to do so.
So I'm hearing higher yields than average and better fundamentals than average. How are you feeling about balance of the year?
Yeah, so the first half of the year, as you mentioned, we've absorbed a bunch of rate volatility. We've absorbed a bunch of, call it headline risk around things like Middle East conflict, the effect on oil, the effect on inflation, and still eking out very small positive total returns. Now, those total returns are entirely income minus a small amount of capital depreciation for, call it roughly speaking, the first half. Now, I think the capital piece of that equation can be recouped in the second half of the year fairly easily. So I would most likely predict that the second half of the year would be a yield plus capital appreciation type of performance expectation, in part because expectations have shifted so much already, and they can shift back fairly quickly. And even while absorbing these shocks, muni fund flows, demand for ETFs, mutual funds, and SMAs, all very robust. So I think that bodes well for potentially a little bit of a smoother and more positive total return performance in the second half of the year.
Thank you as always, John.
Thank you, Carl.